Welcome to this month's Mortgage Minute. We've got lots to cover today, and starting from the top, some of the bank's forecasters. Things probably aren't looking as dire as they were a bit earlier in the year. We had a lot of people with uncertainty, not knowing if the rate's going to get back to 9 or the teens like they were in the 90s. Nathan, a lot of the banks have changed their tune as far as the interest rate forecast moving forward this year. What's it looking like?
Yeah, we've seen a number of the big banks come out and sort of revise their forecast on where they think the rates are going to peak. We've seen Commonwealth Bank actually predicting that the 4.1% cash rate we're at the moment is the peak of the rate cycle, and we might start to see rates come back down, hitting 3.1% by the end of 2024. So that's a 1% decrease between now and the end of next year. Westpac has also said we've hit the peak at 4.1%, and we're going to start to see rates drop down to 2.6% by the end of 2025. So some pretty significant rate drops are forecast by the big banks. NAB's the only one really predicting that there's going to be one more rate rise, which will happen in November of this year. Then the cash rate will drop to 3.1% as early as 2025. And ANZ rounding it off, saying we've peaked in the rate hike cycle at the 4.1% cash rate we're at the moment, then dropping to 3.8% by December of this year.
Yeah, so we've actually started to see this come through with the bank's fixed rates. So they usually have fixed rates from between 1 to a 5 year period. And the fixed rates are a bit of a precursor to what's going to happen with the Reserve Bank and what's going to happen, because it's saying, well, what they think the cash rate is going to be in 1 and 2 years' time. So we have seen some of the banks, Macquarie, ING even drop their 1 and 2 year fixed rates. Those fixed rates are still in the 6-ish%, so they're still a bit above the variable rates. Nathan, what are you seeing on the ground? Like, are people fixing their rates? Are they sort of jumping at that? Is it like a few years ago? Are they staying as variable? What's broadly, what are people looking at?
Yeah, typically at the moment, a lot of people are opting to go for the variable rate. And that's mainly because of these predictions by the bigger banks saying it's looking likely we might be close to the rate hike cycle. In that situation, clients are sort of going, well, if I'm going to fix in at a 6.1, 6.2% rate for the next 2 years and rates start to slide backwards, maybe it's not the best idea. Now, I guess a big caveat here is, although the banks are predicting we're close to the peak of the cycle, actually anything can happen. And the Reserve Bank themselves have sort of said, steady as she goes, we're going to be based on the data that comes in. So if inflation stays high, if the unemployment rate stays high, if a number of these factors and the data points the Reserve Bank's looking at don't change significantly, we might actually see more rate hikes coming, and really a reversal of what the banks have predicted. So I think it's really anyone's guess. We've seen the big banks have been actually incorrect in the past with some of their predictions, because it's based on so many different factors that really one change with a certain data point the Reserve Bank looks at will change the outlook with the rate horizon.
And the rate horizon on that, the mortgage cliff that was meant to be coming out this year. So all the people that fixed their interest rates in 2020, 2021 have reverted back from their 2% up to sort of 6% in the current market here. And there was concerns in the market about distressed selling. So what have you sort of seen on the ground, Nathan? Has there been blood on the streets? What's it looking like?
Well, once again, a lot of these fixed rates have started to end mid this year, and they're starting to come through. Now, once these fixed rate ends, we know that a lot of those borrowers had buffers. So what the Reserve Bank always talks about, these lags. There's going to be lags in what this fixed rate cliff actually means. We know on the ground, talking to a lot of our clients, there's some clients that are really feeling the brunt of these rate hikes, and there's others that aren't really feeling it all that much. So it feels almost like it's not affecting the economy and consumers all equally. And we know borrowers that purchased in the last 2 years had typically larger mortgages. So there's obviously going to be more of an impact to those borrowers that have higher, larger mortgages, those jumbo mortgages, compared to those that might have bought 3, 4, 5 years before, where they're able to get a lower mortgage and there's less of a commitment on the family budget. So definitely going to be an interesting one to see what happens.
Yeah, the other thing I've seen a bit of people that might have bought 2, 3 years ago, when the employment market probably wasn't as tight, have benefited from some of the changing conditions where unemployment's at all-time lows. They're able to renegotiate a bit of a salary increase, or there's a bit of a shifting sands where during COVID, there were a lot less people living per household because you couldn't physically move around, sort of one person to a big home. We're seeing a bit of a change there where people are going back to, well, can I rent out a bedroom? Can I, make a bit of extra money doing this, side hustle and that sort of thing. So there has been a bit of a structural shift I've seen there. People are potentially not looking necessarily at studios, they're looking at sort of bigger spaces for that reason.
Yeah, and in my personal opinion, I think with the Reserve Bank, they're going to be very careful how they go from here. They've done a lot of rate hikes in a very short period of time. So I think personally, from my point of view, they're really going to try and leave it as long as possible to see how these lags impact the economy. There's going to be things like if we start to see rates rising in the US, that might put pressure on the Australian market, because if our Australian dollar tanks, then there's going to be higher costs and inflation will get out of control. So it's a very difficult balancing act that they're going to be taking into account here. But I do believe that they've got to take it very steady as she goes, because it is impacting some parts of the borrowing market far more than others. And they don't want to get to a point where, there's a domino effect. They're pushed too hard and then the whole house of cards comes tumbling down.
Yeah, and so on the banks, there has been talk of loyalty taxes. So this is more if you've got an existing mortgage, if you're an existing homeowner, you've had your loan for a couple of years. Maybe do you want to explain how that loyalty tax broadly works, I guess in the context of maybe a mobile phone plan or different things and what you're seeing?
Yeah, typically this is where the banks, like an electricity company, like your internet bill, like any of those bills that you have that you set yourself up with the provider, they typically rely on the fact that you get a little bit complacent, you get a little bit comfortable with that provider, and you're not going to change. But what they do is they slowly creep up your costs. So I've seen that with my own electricity provider. You stay with them for a number of years, and then you look at the rest of the market and you realize, hey, there's way better deals out there. And that's exactly the same with mortgages. With mortgages, in a lot of cases, you're going to be paying a loyalty tax the longer you've been with your bank. That margin or that amount that you're paying in additional to what the rest of the market's paying is about 0.5%. So that's 0.5% more on average that borrowers are paying for their loyalty to their bank. So that's something that we're seeing quite common at the moment.
Yeah, so a couple of ways you can tackle this. One, probably the most common is increase in property values that the bank won't factor in. So if Nathan bought his home 5 years ago with his bank, he's been paying it off. The property has probably gone up in value, especially over the last couple of years. So you get different deals depending on how much equity or how much you paid down your loan. So an existing bank generally can't factor that in. They won't do a new valuation. So as a broker, we can help with revaluing your home and checking out, is there a better deal? You're at 50% LVR, you're at 80%. What can you do? You might have paid lender's mortgage insurance back in the day. So that's the first thing. The second thing is even just renegotiating with your existing bank. You can call them up and have a look at their website and say, can you give me a better rate? What can you do? Or as your broker, we help with that as well.
That's exactly right. So if you have existing loan with a broker such as ourselves, just hit us up. Let us know. We can talk to the bank directly. It's something that we do try and be very proactive with our existing clients and price and talk to the bank on their behalf, on our customers' behalf, to try and get the rate down. So it's something that you definitely want to do and make sure you're not paying that loyalty tax.
The third thing we've seen that's been a pretty big step change. Up until a few months ago, there was some massive cashbacks available. Nathan, what are you seeing? If you switch banks, what does it actually cost to refinance? Is it really expensive?
Yeah, definitely. Look, at the peak of the refinance cycle, we're seeing lenders give up to $4,000, $5,000, even $6,000 to refinance your mortgage. That's astronomical. I mean, to give you an idea, that's tax-free money. That's money in your bank account. You can spend it on anything just for moving. Now, the cost of moving your loan ranges from about $800 to $1,200. So the banks were giving that incentive to really cover your costs and then be ahead by a significant amount just for the privilege of really moving your loan to get a lower rate or to get a better deal. As of today, we've seen a lot of the lenders cut that. So the $4,000 refinance rebates, a lot of the banks have gotten rid of that. A lot of the lenders have removed their cashbacks altogether. So it is harder to get. We've still got a number of lenders offering those cashbacks.
Yeah, and it's worth just having a look and doing the numbers, because it could be a case where, when you forecast it, it might cost you $1,000 to move, but you can recover those costs within 6 months. And as your broker, as Hunter Galloway here, we can help out with that.
Did you know here at Hunter Galloway, we're a mortgage broker and help people right across Australia. If you need assistance, hit us up at huntergalloway.com.au or call us directly on 1300 088 065. Guys, thanks for watching and we'll see you next time.